So in this video, I'll talk more about strategies. One of the most common questions I get is, Adam, once I find a stock that I want to trade, what are the most effective option strategies I can use to trade a stock? So there are many option strategies and there are pros and cons to each strategy. So I thought that for this video, I will talk about the 4 simplest option strategies and the pros and cons of each one. And let's use an example. Let's look at everyone's favorite stock, Tesla, one of the most popular retail stocks. So Tesla, let's say you want to trade Tesla right now. Now, of course, you could buy the underlying shares and just put a stop loss if you're trading, or you can trade them using options. So the first question to ask before you trade is, what's your directional bias? So you can be strongly bullish, moderately bullish, neutral, moderately bearish, or very bearish. So first pick a direction and then decide on the strategy to execute that direction. Now, looking at the charts, again, we can't predict the future exactly, but we can look at charts and come up with a probability. So we look at Tesla, the chart itself, I would say that you can be moderately bullish, right? Why? Because look at the charts. First, if you look at the price action, now this was obviously a downtrend, right? Wave up, wave down, wave up. So this was the downtrend pattern. Then over here, it reversed to an uptrend pattern, right? We've got a wave up over there. And recently, we've got a bit of a retracement to the 50 moving average. And it looks like it just bounced off the 50 moving average. So we could see it, consolidate or move up slightly. And that's why I'm saying that I'm moderately bullish, but not very bullish. Why not very bullish? Because, well, the 20 EMA is above the 40 EMA, which means the short-term trend is up, but the longer term trend is not up yet because you can see it's still below the 200 moving average. The 200 is still sloping down, and the 50 moving average in blue is still below the 150 moving average in green. So that's why I keep saying moderately bullish but not super bullish. If you take a look at some of the indicators, you can also see that it's not super bullish yet because, for example, the force index, it's still, below 0. So that's still not really bullish yet. The MACD is still in a bearish phase, right? So because of that, again, to conclude, let's have a moderately bullish view on Tesla. So given that, what kind of option strategies can you use to trade if you think that it's going to go up, but not that much, right? Or go sideways a bit? Well, the first simplest strategy is to simply buy a call option. And that's what most people do. They just buy a call option. So for example, let me just bring up the option tab over here. And let's imagine you want to buy a call option on Tesla to bet on it going up. What date to expiration would you choose? It's up to you. But usually you want to choose at least more than 30 days because if you choose too short a duration, you don't have enough time for it to go up. And every day you hold a call option, it's losing time value. And the shorter the duration, the faster you get the time decay or theta decay. So you want to select at least 30 to 60 days so that the time decay is not so rapid. All right. So let's just select 34 days as an example. Yeah. Okay. Now, of course, if you are bullish, you want to buy calls and not puts, yeah? If you're bearish, you buy puts. You're bullish, you buy calls. So you want to buy a call option. And you may say, okay, what strike price do I choose? Again, different people have different styles. You can choose deep in the money, at the money, or out of the money, all right? So the simplest thing to do would be to just choose it at the money, all right? Which is what I normally do. So if you choose at the money, you're looking at the 50 delta strike, which means you buy the call option at 183.33 strike price because that's like a 50 call. Okay, so if you buy this call, like click buy over here, there we go. You can see how much will it cost to buy the call. It will cost $13.25. Now, one option contract is 100 shares. So you have to multiply by 100, okay? So what's the cost of buying this call option? $13.25 times 100 is 1325, $1,325. Okay. Now, the first question is, what's the advantage of buying a call option versus just buying the shares? Okay. Now, the main reason people buy call options is because it costs less money to control the same number of shares. So, for example, if you were to buy 100 shares of Tesla, okay, and Tesla is now trading at $180 roughly, okay, so that's 18 grand. So you need $18,000 to control 100 shares, okay? But with a call option, instead of $180, you only require $13.25 to control the same 100 shares. So less money, control the same number of shares. We call that inherent leverage. So basically, you use call options to leverage your position. I'm not saying it's good to do that. I'm just telling you why people do that, right? Okay, so again, $13.25 times 100, your capital required would be 1,325, 1,003 versus 18 grand. So that's the main advantage of using a call option: less money, control 100 shares. So that's a good thing, but there are a lot of bad things that come with it, right? The bad thing is this: if you just buy the shares, you can have the patience to wait for the price to go up. If it doesn't go up, you can just wait and wait and wait until it goes up, right? So time is not working against you. But when you buy a call option, remember, when you buy an option, it's a decaying asset. And what that means is that every day, that option is losing value because of the time decay, right? So it's losing value until eventually it will expire worthless on the expiration date if the price doesn't go up enough to cover the cost of the call option. So the main thing to understand when you buy call options is that not only must the price go up, it must go up fast enough and sharp enough to cover the cost of the call option, and fast enough before the time decay kills you. And that's the main disadvantage of just buying a call option. So let me just show you how that looks on the profit and loss chart. Okay. So you can see if I click confirm and send, you can see now the maximum loss when you buy a call option is the premium that you pay. So the most you can lose is the price you pay for the option, which in this case, the most you can lose is 1,325. That's the maximum loss. Okay. But what's the maximum profit? Now, theoretically, if Tesla flies to the moon like crazy, your maximum profit is infinite. Right, it's infinite profit. Now, it sounds good, but in reality, it doesn't fly to the moon that often, okay? So don't get too excited about that infinite part. So let me just open up the profit and loss chart and let me show you what it looks like. Okay, there we go. So when you buy a call option, essentially this is what it looks like, okay? So on the x-axis, horizontal, you have got the share price. So currently, what's the share price? The share price is currently the one at the center here, $179. That's the current share price. So the share price can go up, or the share price can go down, or the share price can stay where it is. All right. So again, the x-axis is the share price. On the y-axis, you can see the profit and loss. So the zero is zero, right? Now, anything above zero, you're making money, right? That's a profit. Anything below zero, you're making a loss, all right? Now, what's this purple line and this green line? This purple line shows you the profit and loss right now based on this date you see here, which today is the 18th of March. Yeah, I know it's a weekend, but let's just simulate, right? If you buy this, obviously you have to buy it on Monday, which would be the 20th of March, all right? Now, you can see that the green line, on the other hand, is the profit and loss at expiration, which means when the option expires on the 21st of April, which is about 30 days, at expiration, your profit and loss will be this green line over here. Now, the trouble with most people is when they enter a trade, they always think they're going to make money. You can't think that way. As a trader, you have to always calculate how much you're going to lose if it's a losing trade and how much you're going to win when it's a winning trade. Because every trade you take could be a winner or loser. You never know. It's a probability. You can't win all the time and you can't lose all the time. So if you take a look at, let's go back to the charts again. And again, what's the current price of Tesla? It's somewhere about there, right? 173 to 180. Now, you can see the closing price was 180, but the bid and ask price after the market is about 178, 179. And that's why you can see the option was actually priced based on the bid ask price, okay? But the actual closing price was 180. So the question you got to ask is that, where do you think Tesla will go if it goes up, if you assume it's going up? And you could assume that, yeah, maybe it may go up to this previous high over here, for example, right? So you got to have a target that you're going to take profit. So let's say you think it's going to go up somewhere over here to this high or to the 200 moving average. So let's say that's your target, 217. Now going back to this, you can see if it goes up to 217, let's drag it to 217 there, okay? So if it goes up to 217, how much money do you make? All right. So if I put this mouse over here, you can see that now if it were to go up immediately, the moment you buy, it goes up the next day. Let's say you buy it on the 20th of March, for example, which is Monday, and the next day on the 21st of March, boom, it goes up, which is unlikely, but let's say it goes up. You can see straight away what's your profit. Look at this purple box on the left, and what does it say? Or the purple number on within that box. It says you will make 2542.99, or round it off to 2542. So let me write this down. So if Tesla goes up to here, you will make 2542 in profit. This is at $217 target price, right? As you can see. Then the question would be, okay, what if Tesla doesn't go up? What if Tesla goes down? Okay. Now again, you gotta have a point where you're saying, okay, if it goes down to a certain level, I'm gonna cut loss. I'm gonna close the trade. You gotta have an exit plan if it doesn't go your way. So let's say if Tesla drops, below this low over here, let's say it drops to, for example, let's say it drops to 160, you're out, right? Cut loss at 160. So if it goes down to 160, let's bring this to 160 over here. Okay, how much would you lose? Now it depends again on how much time has passed, right? So again, let's say the moment you buy, it drops all the way to 160 in one day. By the 21st of March, then you would lose $813.98, or let's say 814, okay? 814. So many people would think to themselves, okay, so if it goes down, I cut loss, I lose 814. If it goes up to 217, which is the target price, I make 2005. Hey, I'm risking $800 to make $2,500. Not a bad deal. What they failed to realize is the impact of time decay. Remember, whenever you buy an option, or whether it's a call option or put option, every day you're losing money because of time decay. So let me show you how this plays out on the charts. So again, remember that your profit or loss is this purple line right now, okay? But this purple line will keep shifting down every day as time passes. So now it's, let's say it's the 21st. Well, let's go back. Let's say you enter the trade on the 20th of March. Now, what happens the next day? It becomes the 21st of March. Now, watch what happens as I simulate time passing every day to the 22nd, 23rd. Now, look what happens to the purple line as time passes, right? look what's happening to the purple line as time passes. Can you see that? Can you see that as time passes, the purple line is dropping to the green line, and eventually when it reaches the 21st of April, right, the purple line will go to the green line. So at expiration, there's no more time value left. So this is the main drawback of just buying a call option, because time is working against you. If the stock price doesn't go up fast enough, you will lose money even if the price stays where it is or the price moves up slightly. So you can see, for example, if Tesla didn't go up, it just stayed at 179 and you held it to expiration, the time value would drop and you would lose your entire premium at expiration. Even if Tesla's price went up and you were right on a direction, but it did not go up enough, you can see that at expiration, you end up losing money as well. In fact, to break even on the trade, Tesla has to go up enough. It has to go from 179 to beyond this price, which is 196.58. So this is called the break-even price at expiration. Let me just write it down here. Your break-even price is 196.58. So that means that not only must Tesla go up, it must go up enough just to break even and for you to make money beyond this point. Now, to get this break-even price, it's actually the strike price, which is 183.33, plus the premium that you pay, $13.25. So Tesla has to go up at least $13 before you can break even at expiration. So this is the main disadvantage of using call options. Again, you can use call options, but if you just buy a call option, you need the price to go up fast enough and significantly enough to make money. If the price goes up a bit or goes up slowly or stays the same, you're going to lose money. That's why I don't recommend people buy call options when trading stocks. Buying call options are like playing the lottery. Once in a while, if the price goes up very fast, you make a lot of money, but it's very rare. More often than not, in the long run, if you just buy call options, you are going to lose money if the price goes up a bit or goes sideways. So again, unless you're super bullish, forget buying call options. So what other option strategy can you use that has got more advantages with lower risk? Well, the next method I'm going to show you is called a bull call spread. So what does that mean? A bull call spread is, instead of just buying a call option, now we're going to buy a call option and sell another call option at our target price. So this is basically how it works. Let's take a look at the charts once again. So again, in the first method, we simply bought a call option at the current market price. But now we're going to buy a call option and simultaneously we're going to sell a call option at our target price. So why? Now, why sell a call option? Remember, when you sell a call option, you collect money, you collect premium. When you buy a call option, you have to pay money, you have to pay the premium. So by selling this call option, we are going to collect some money over here and we're going to use this money, this premium, to pay for part of the cost of the call option. So it offsets the cost of the call option. So this lowers the cost of the trade and lowers your risk, and at the same time, it increases your break-even price. So let's see exactly how to execute this. For that, I'll see you in part 2 of this video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.